Hello and welcome to our first Charter Hall quarterly update for 2021. I'm Scott McLennan and I'm Head of Distribution at Charter Hall. Well, it's been a very eventful quarter. With the world still under the grip of the COVID-19 pandemic, we've seen the beginning of a rollout of several successful vaccines across the world, with Australia looking to begin its program to inoculate its population beginning in February this year. This has all given us hope and optimism that 2021 will see a return to the normal freedoms and movements that we enjoy. We've witnessed global headlines with chaotic scenes in the United States following the Democratic Party election win, which many expect will see a more subdued approach towards global trade policies, and in particular, that with China. The United Kingdom finalised its Brexit agreement with Europe, and there was record stimulus from reserve banks globally, resulting in new record highs across global equity markets. At Charter Hall, we've continued to grow our business around the core principles of providing high-quality assets to well-regarded tenants in resilient industries. 2020 has been a great test of our strategy and processes, and I'm pleased to advise that each fund produced above benchmark returns for the past 12 months. During the last quarterly update, I mentioned that we were expanding our distribution team. We've since welcomed 2 new members to the team with over 20 years' experience. We welcome both Renee Oldfield as our State Manager for South Australia WA, along with Paul Ramsey, who has joined us recently as State Manager of Victoria. Craig Harding has also relocated to the Sunshine State to look after our Queensland clients. I look forward to being able to once again travel interstate to meet with you all. In the meantime, you'll hear from a member of each of our team in respective states to ensure you have all the information you require to meet your clients' needs. I hope you enjoy Steve's update and have a great start to 2021. Thank you.
Thank you for joining us for an update on the Charter Hall Direct suite of funds. I'm going to cover off the performance for the quarter ending December 2020. I'd also like to remind you that good housekeeping says I need to highlight that everything I'm about to say today is general information only. Please do not take anything from myself or any of the other guest speakers as financial advice. And if you hear about a product that you are thinking about investing in, always read the product disclosure statement or information memorandum in full. This quarter's session is a little bit different in that the ex-Folkestone funds will be covered as part of their written updates rather than as part of this video session. So this slide up here on the screen brings together a number of concepts which Charter Hall implemented and does particularly well, and which helped us manage through the global pandemic and still deliver outperformance for our investors. The first item is around agility and transparency. So despite Charter Hall being the largest manager of third-party commercial real estate in this country, we do make decisions extremely quickly. The CEO, the CIO, senior management are always available to review and approve decisions and adjust strategy as needed. The best example I can give is in a 6-month window in the middle of the pandemic, we undertook 3 lots of independent valuations. We did that because we wanted to ensure that all our investor clients had the most up-to-date and accurate information at all times. We're a tenant-focused organisation. At Charter Hall, yes, our head office is in Sydney, where I'm standing here, but we have key teams located in Brisbane, Adelaide, Perth, and Melbourne, or basically wherever we own assets. That's a key point of difference, and it's meant that regardless of whether the borders are open or closed, we had people located on the ground who can deal with our tenants, negotiate new leases, inspect properties, and make sure things keep moving forward. We're a particularly risk-focused organisation. So it doesn't mean our investments have no risk, but what it does mean is we try and work very, very hard to remove as many of the known risks as we can. A good example again is the way we moved on the Direct Office Fund and PFA in the middle of the pandemic to extend out the lease terms, meaning we weren't exposed to refinance risk, and as well as lowering the interest expense for the benefit of our investors. Relationships. Anyone that's worked in property will tell you relationships are key to everything we do. Whether it's securing the best assets, negotiating leases, or making sure our tenants want to stay in our buildings, relationships are key. The way we manage relationships is we work in a partnership with our tenants because we know the tenants are the ones who pay the rent, and the rent is what we then pay through to our investors. These relationships have meant many of the acquisitions we've been able to achieve. So for the Direct Industrial Fund number 4, for example, the majority of acquisitions have been off market. That means we're not competing, with everybody on there to buy the best assets at an elevated price, we've used our relationships through agents, vendors, other property people, private equity to unlock opportunities to the benefit of our investors. And in many cases, we believed we've been able to secure those assets at prices lower than they would have if they transacted on the open market. Active portfolio management. So we're not an accumulator of assets at Charter Hall. We're not interested in our management fees going up because we're building bigger portfolios. What we want to do is deliver the best investment performance because we know investors will continue to come with us for the existing products and as we launch new products. So you'll hear me talk later on in today's update what we've done with the Automotive Trust number 1 and number 2 around actively selling down assets, as well as being very active in leasing extensions to our full suite of tenants wherever we can. A good example is where a tenant may have had cash flow issues in the middle of the pandemic. We try and work with them. So we might have given them some rent free, but we also are very focused on the investor outcomes. So wherever possible, we would then push out the lease term, meaning our investors get a longer period of secure income. And finally, the returns and the volatility. So volatility is how much the unit prices have moved, have outperformed. And in fact, that is a great segue into the next slide where I'll run through the performance over the last 12 months for the direct suite of funds. So this screen up there shows the 12-month returns of the direct suite of funds, both open for investment and the fixed life funds. What I'd say there is you can see here the benchmark return, which does include a portion of discretion retail, actually generated negative 2.8% over the 12-month period. Pleasingly, every one of our funds exceeded that benchmark by 8% or more. In fact, you can see here, and I'll call out 2 absolutely stellar performances in the BW Trust, which owns 4 Bunnings, as well as DIF2, which dramatically outperformed. So firstly, with BW Trust, what we've seen in the last 12 months is an insatiable appetite for high quality, long leased Bunnings assets. It's meant that this investor demand has decreased the property yield and property prices move inversely. So a lower property yield means higher prices for these assets. And that was a key contributor to that level of performance. DIF2 and DIF3 also did very well as they were sitting in an industrial logistics market and benefited from around 40% gearing. So in a rising market, that gearing accentuates the returns delivered for investors. For our open suite of funds, they had slightly lower returns, mainly because they had lower gearing. For a number of funds, we were partway through acquisitions when the pandemic struck, but we thought it was prudent to pause and wait. So these funds typically had a lower gearing level over that 12-month period, which has contributed to why those returns, while still significantly outperforming, are a little bit lower. But 12 months returns are one thing, but I think what's more important is how are the funds performed since they were first launched. Remember, unlisted property should not be thought of as a short-term investment. In fact, I regularly tell people, if you want exposure for 12 months or 24 months, this is not the investment class. However, if you want secure income at significantly higher yields than the cash rate and are prepared to invest for 5 to 7 years, then unlisted commercial property may suit your portfolio. And again, pleasingly, what I would say here is every one of our funds since they were first launched has beat the benchmark returns. The benchmark returns are the grey bars, and in this case, the benchmark changes depending on the timing of when each product was launched, but in every case, we've been able to generate outperformance. And these returns are a per annum basis. So they are comprised of a portion of monthly and quarterly distributions, depending on the fund, as well as movements in the capital value or the value of your investment. So I've now just talked about the 12-month total returns and the returns since inception. But what about the value of the units that you and your clients may have invested in these funds? We can see here pleasingly every fund is above the dollar. I do encourage you just with that too to understand that although it says 33 cents, that's because we've sold assets and we've already returned the capital to investors. In fact, that down the bottom there has a unit price of $1.09 if you include the capital that's already been returned to investors. So as well as providing regular income yields, so typically 5.5% or better, we've been able to increase the capital value or the amount that people have invested, assuming they came in when these funds were launched. Moving now to the fixed life funds, you can see up on the screen DIF2, DIF3 and BW. Despite the first column all showing 100%, it is worthwhile explaining why we continue to show that. In a period we've just gone through with the most uncertainty and the most stress in the market we've seen across all investment classes, having portfolios that benefit from full occupancy has meant that the income has kept getting paid by our tenants, which we then continue to pass through to our clients. It means that we're not doing leasing at times in the market where we don't want to. And when you couple those high occupancy rates with the average lease terms ranging from 11.5 on Div 2 to 7.9 on BW, that's what generates the secure income streams which our investors value so highly. You can see there the tenants, some big names, many brands that you're familiar with, and we always focus wherever possible on the strongest financial strength for our tenants. It means tenants with strong balance sheets, great cash flow that can go through different cycles. And in fact, if you look at Coles and Woolworths, they're some of the entities that have benefited through the pandemic where their actual turnover has increased. But I'll let Sianda talk about that more later on in today's session. The next slide up here gives a little bit more colour and information on the Direct Automotive Trust number 1 and number 2. You heard me earlier say that we will sell assets where we believe that the risk-adjusted returns have been maximised for our clients. The key word there being risk. So we're not trying to just shoot the lights out and get the highest returns. We want to make sure we understand what risks we're taking. And when we looked at the automotive sector and the period of increased flux that it's going through, if we could get above benchmark returns and above valuations, we decided that it would make sense to sell assets and return the capital back to investors. Pleasingly, I can now report as of yesterday, we've sold the last asset in DAT1, being the Hillcrest Queensland property. In fact, that asset has been sold at a 13% premium to the last independent valuation, generating an additional 3.7 cents per unit uplift for the benefit of investors. So if you look across both these funds at 10.9% and 8.3% per annum average return since invested, that's a return profile we're very proud of. I've had a few people ask, well, Stephen, used cars and new car sales are booming, you should have held on. I think that's the wrong way to look at it. That may be what's happening at the moment, but what that doesn't give you insight into is where does the capital who want to buy these assets. You don't want to get greedy and you don't want to try and sell these assets when the lease terms get too low or try and time the market to perfection. If you can realise a fantastic exit price, as a manager, that's what we will do. We'll return the money to you or your clients and back you that you can invest your money into another profitable investment. The next fund update I'll give is on our most recently launched fund, the Wholesale Property Series number 1, or we love acronyms in property, WPS1. As you can see on the graph on the right-hand side, on both a total return basis and on a comparative to benchmark basis, the fund has done exceptionally well. I should also point out that this fund is only available to wholesale clients. So it means for those who are looking to invest, you do need to have an accountant's certificate and the minimum investment amount is $250,000. This fund has proven extremely popular and in under a year, we've raised almost $100 million in equity already. You can see here the unit price following 31 December revaluations has been uplifted to $1.07 and that's what's fed into a large part of the total return. Investors should also be aware that this fund will have a lower running distribution yield, typically around 4.5% and growing over time than our typical funds that are available to retail clients. So what does the fund invest into? Well, this fund invests into a number of wholesale and partnership vehicles managed by Charter Hall. So instead of needing $10 million or $100 million to access those investments, we've made it available to our many and varied high net wealth clients. You can see here the top 5 tenants. In fact, the top 4 tenants are over 55% of the net income roll, and I think you're going to struggle to find a more diversified, stronger set of tenants in Bunnings, Telstra, the Australian government, and Woolworths. Importantly, the investment committee working with management has allocated the WPS1 investments across the numerous sectors, heavily weighting initially at least to industrial and logistics, the hardware portfolio being the Bunnings, as well as getting social infrastructure and office exposure. So look, that gives you a good update. WPS1 is launched under 12 months ago and it's already performing. That brings me to our first guest speaker for today. We have Sean McMahon, who's the CIO or Chief Investment Officer for the broader Charter Hall Group. He's also a member of the Wholesale Property Series #1 Investment Committee. Sean is responsible for the broader group strategy across our investment capital transactions and M&A activity. Sean has over 30 years of property and investment banking experience and is highly motivated to deliver resilient earnings for Charter Hall and our investors. Please welcome to the stage Sean McMahon. So thanks for joining us, Sean. You've just seen up there on the screen the outperformance of WPS1. It was launched in March last year. Probably the worst possible time to launch any product, whether it's a property fund or an equities fund. Why do you think the fund has outperformed and done so well for our high net wealth clients already?
Yeah, good morning, Steve, and good morning, everyone. Look, it's no real surprise to me, to be perfectly frank, how this fund has outperformed. As you just have shown on your slides, returned 8.3% in the last 6 months relative to the index of 2.8%. That's nearly 3 times outperformance. What drives that? In our view, what drives that is 3 things. Fundamentally, this fund is anchored to the best strategies that Charter Hall's rolled out in the real estate investment space over the long term. And fundamentally, direct investors or our retail investors are getting access to major wholesale scale strategies that have access to large scale real estate assets that are modern or new, anchored by a long WALE, nearly 11 years in this vehicle, with fixed escalators or rent reviews of 2.7%. And if you look through who's paying the rent, as you just touched on, Steve, nearly half the rent is anchored by Woolworths, the government, Bunnings, Telstra. These are the biggest brands in Australia, and that provides long-term income security in our view, and also will naturally lead to resilient outperformance in the long term.
And you're right, many of these assets that WPS1 has an indirect investment into are the largest, most expensive assets. So even if you're a high net wealth client that may have $10 million to invest, this is still out of the reach for you usually. So I guess by lowering that entry point to $250,000 and giving, as you said, those best ideas and making them available, that is a key point of difference. So Sean, we saw WPS1 has a mixed allocation across different sectors. As a member of the ISC, how do you decide on whether to go into industrial and logistics, office, long WALE hardware, Bunnings? Can you give the audience a little bit of insight into, I guess, the thought process of the committee?
Good, yeah. And look, that's a great question, Steve. So as a committee member, we've spent a long time looking at the various medium to long-term outlooks for all the sectors. This is a diversified strategy, which is critical. And fundamentally, one of the advantages with investing into a Charter Hall strategy of this nature is we have major scale in the Australian real estate market. At 45 billion, we have deep access across all the major sectors in Australia. That naturally leads to scale being a strategic asset, and that provides strong off-market opportunities. We know where our major tenant customer base wants to grow. We know which sub-markets are the preferred markets by many of our major tenants. And what this provides is unique ability to have deep market penetration, but also to provide our investors via this vehicle access to the big brands that we've just touched on in terms of tenant covenants. And over 50% of Charter Hall's entire funds management platform has repeat business with some of the major players in Australia.
Thanks for that, Sean. It's really good to hear the fundamental thesis behind the Telstra exchanges, which happens to be one of WPS1's most recent acquisitions, and in fact it was acquired during the December quarter. So look, while we've got you, any last words in terms of what to expect from Australian commercial real estate, I guess not just in the next 12 months, but on a medium to longer term basis?
Yeah, thanks, Steve. Good question. Look, our view is that real estate, which is effectively a hard asset or a real asset, is well positioned looking forward in this lower for longer environment where interest rates are the lowest historically we've ever seen, around 2% at the moment. And if we can provide to our investors and our direct clients yields of 4.5% to 5% on tier one quality assets underpinned by some of the major brands and covenants in Australia, this provides a naturally very strong spread to bond yields, which are 1%, and if you invest in term deposits, etc., in savings, about 1%. So those spreads are higher than what we've seen for decades. And this spread will provide excellent outperformance, in our view, in hard assets or real estate in the future, particularly in industrial and logistics, driven by the tailwinds of e-commerce and online, and also into social infrastructure and other long WALE diversified strategies that we're embarking on in WPS1.
Well, fantastic. Thank you for that update. And look, I guess what I would also highlight, WPS1, as I said, is a wholesale client only, so you do need an accountant certificate. It does have a high investment minimum of $250,000, but many of the thematics which Sean just talked about, that long lease term, that focus on strong tenant covenants, that's something we focus on across the broader suite of funds. So you don't need to get invested in WPS1 to get exposure to those concepts and things that Sean just said. So thank you very much, Sean. That's a great update. I'll now move on and give you an update on each of the open funds in the direct suite. So the first open for investment fund I'm going to talk about is the Charter Hall Direct Office Fund. In fact, it's our largest fund at $2.5 billion, is very diversified across major CBD markets in Australia. It benefits from a long weighted average lease expiry of 8.3 years, and we just heard from Sean McMahon how important that is because it provides that income stability. When you combine that with a high occupancy rate of 96%, and you can see up there on the screen the key tenants being the New South Wales, federal and other state governments, Suncorp, Coles, Western Sydney University and Westpac, the fact these 5 tenants account for over 60% of the net income of the fund is a fantastic position to be in. So DOF benefited from some revaluations at 31 December, primarily on the long leased assets, where investors out there are chasing these particular property investments because, like us at Charter Hall, they believe that the longer term income streams that are secured by these tenants are highly valuable in a low interest rate environment. The next fund I'll talk about is the PFA fund. Again, it's an office fund, very large, not quite as big as DOF, but at $1.7 billion, it provides diversification across all key geographic regions in the Australian office market. Different to DOF, it provides monthly distributions. So we know a number of our clients really value those distributions that are paid to them on a monthly basis. The total return at 5.3% still beat the benchmark by 8%, but it was a little bit lower than DOF, primarily because PFA had a lower average gearing level throughout the year. During the December quarter, we acquired an asset, which I'll talk about towards the end of today's presentation, which has got the fund's gearing back within target range of 30 to 40%. We kept the gearing lower and we paused the acquisition pipeline during the middle of the pandemic as we wanted to be conservative and see what happened. And now we've got the vaccine on the way. It gives us more clarity, more certainty, and more confidence to acquire those high quality assets. The largest tenants in PFA are government entities at over 50% of the rent roll. That's incredible that we've been able to achieve that in a diversified fund across many different properties. And it's not an accident, it's because we've targeted these tenants and they are the most secure and strongest financial covenants you can get in the market. The next fund, our flagship industrial fund, the Direct Industrial Fund number 4, is now over $1.2 billion, over 20 assets, and you can see here the occupancy at 99%, and this fund also has the longest weighted average lease expiry of 11.1 years in the funds that are open for investment. It pays distributions on a quarterly basis, and as you heard from Sean, the industrial and logistics markets, whether it's in Australia or on a global stage, are in hot demand by investors. A key strength of Charter Hall and the team is we've leveraged our relationships and we've been able to acquire a large number of assets in this space for the benefit of the fund's investors by not competing on market but using our relationships to unlock them. And again, you can see there the strength of the tenant covenants who are listed up there, being Ingham's, one of the 2 dominant chicken manufacturers in this country, Visy, a world-renowned global packaging and manufacturing company, Mainfreight, a $4 billion New Zealand market cap entity in the logistics space, and the others which are involved in the food logistics business. The next fund up on the slide is the Long WALE Fund, LWF. This is the unlisted version, so please don't confuse it with the listed vehicle, which we do manage. It has a $227 million portfolio, pays monthly distributions, and it feels like I'm repeating myself here, but also benefits from very strong financial tenants. You're getting a bit of a feel here. This isn't an accident. This is something we focus on regardless of the investment vehicle. This fund is for those investors who don't particularly want to pick a particular property sector, whether it's office or industrial and logistics. This fund is diversified, so it will invest into different assets which we think will deliver higher risk-adjusted returns over the medium to long term. I'll shortly bring Sianda up here onto the stage to give an explanation and give you some insights into why we believe the Woolworths Coffs Harbour acquisition is a real benefit for the Long WALE Fund. So the next fund I'll talk about is the Maxim Property Securities Fund. It's a little bit different to the unlisted real estate funds I've talked about because this fund invests into stocks which are on the Australian stock market, meaning it's liquid. So we think that this fund has a great opportunity in a record low interest rate environment to provide investors not just with income, but total returns. In fact, during the December quarter, it generated a 12.2% return and over a 12-month period beat the benchmark on an after-fees basis by more than 2%. Many of the individual A-REITs that comprise the Maxim Fund are trading at below their NTA, so net tangible asset backing. That's a great sign that you can get in and buy something below value or below independent valuation, as well as being able to generate some strong income returns in what is a listed vehicle. So please, if you are thinking about something, but you are a little bit concerned about investing for 5 or 7 years and you've got perhaps a shorter term investment horizon, then perhaps the Maxim Securities Fund could be of interest to yourself. I'd now like to introduce our final guest speaker for today, Sianda Ma. Sianda is Charter Hall's transaction manager focusing on retail transactions, and she provides some insights into the most recent acquisition of the Direct Long WALE Fund. Welcome, Sianda.
Thank you, Steve, and hello, everyone. My name is Sianda, and as Steve has mentioned, I'm the transaction manager at Charter Hall. I won't bore you all with what I do on a day-to-day basis. However, a key part of my role is to filter through and review acquisition opportunities to find quality assets for the fund. I'm here today to talk you through all the latest acquisition made by the Direct Long WALE Fund, being the Woolworths supermarket in Coffs Harbour, New South Wales. This property is a standalone supermarket, 100% occupied by Woolworths and includes a BWS liquor store, with a current weighted average lease expiry of 8.8 years. I view this as an ideal investment for the fund. A convenience, non-discretionary supermarket is a very defensive asset class. Supermarkets are classified as essential services and has demonstrated to be extremely resilient, even in tough market conditions, which we have all experienced recently. What appeals to me from this property is a strong tenant covenant being leased to Woolworths, a brand that we're all familiar with, and also as an ASX-listed company. Tenant strength is an important measure as it underpins the income security that the property can provide. What this ultimately means is that with the income security, the fund is able to have committed, reliable income return, which ultimately pass on to investors. Another key attribute I want to highlight is the sales productivity at the store is above the average benchmark. A good store generally would perform about high mid to 30 mil. A strong performing store will do sales in the 50 mil range. This store sales is well above the 50 mark. So in my view, I say this is an exceptional store and has strong sales productivity. I often get asked, what do I look for when I review acquisition opportunities? There are many factors. However, the 4 key ones in my view, one being who is a tenant. As I mentioned earlier, tenant security underpins income security for the asset. The location of the asset. Is it in a prime location and the surrounding competition? Ideally, you want a dominant player in the catchment. In the likes of Woolworths Coffs Harbour, it occupies a prominent CBD site and is a dominant player in the area. Third being, what turnover or sales the store is generating. This provides a good indication of the sustainability that tenants is able to make its rental payment. As you're well aware, if there's any risk with rental payments, this has a negative impact on the fund. And finally, the lease structure. Like many commercial leases, we're able to recover operating expenses from the tenant. This minimizes any income leakage risk in the event there's a spike in operating expenses. A landlord-friendly lease provides the fund with a stable, positive income return. Well, that's all from me today. Thank you for taking time to listen, for me to speak to you about the latest acquisition made by the Direct Loan Whale Fund. Back to you, Steve.
Thanks for that, Sianda. And it's always good to get the experts in the field, the ones who are involved in the asset due diligence, and they can explain a bit of the behind-the-scenes rationale on why we make some of the investments that we do. That's also a good lead-in for what you can see up on the screen, which is two of our acquisitions that happened during the December quarter. PFA, as I mentioned earlier, was running at a lower gearing level. In Q4 last year, we acquired a 50% interest in 570 Burke Street. It benefits from 100% occupancy, a strong weighted average lease expiry of 5.8 years, and over half the income is paid by government tenants. So that's in keeping with the overall thematic of the PFA fund. The final asset you can see there is DIF4's portfolio acquisition. So it has a number of individual industrial assets located as part of this acquisition, and it benefits from 100% occupancy. You tend to get longer lease terms in industrial logistics, so this has an 11.8-year WALE, and it's been a great way to deploy some money up into that Queensland market and get that increased industrial logistics exposure to that state. Thank you for joining us today. If you'd like more information on anything we discussed or didn't cover off, or the open opportunities, please do look at the quarterly report, which is available on our website at charterhall.com.au. Or you can also contact one of the team, whose details are up on the screen. The entire team is focused on adding value to all our property portfolios and delivering outstanding fund performance. We'll continue to do so and work very hard to meet investor objectives over the longer term. Thank you very much for your ongoing support of Charter Hall.